Welcome to the Women's Money Wisdom Podcast. I'm Melissa Joy, a certified financial planner and the founder of Pearl Planning. My goal is to help you streamline and organize your finances, navigate big money decisions with confidence, and be strategic in order to grow your wealth. As a woman, you work hard for your money, and I'm here to help you make the most of it. Now, let's get into the show. If you aren't talking about AI, you must be living in a cave because it seems to be coming up so often, whether it's the investment world, thinking about jobs in the labor market, and in so many other use cases. And so we're going to be talking all about AI and investment implications to AI on today's episode. And I'm thrilled to have a friend and an investment analyst and portfolio manager joining us who's going to be diving in. He's done a really great research report when it comes to AI. So Kai Wu is the founder and chief investment officer at Sparkline Capital, which is an investment management firm applying state-of-the-art machine learning to uncover alpha in large unstructured data sets. Kai, I'm going to let you define alpha during the episode. Prior to founding Sparkline, Kai co-founded Kaleidoscope Capital, which was a quantitative hedge fund in Boston, and worked at GMO, where he was a member of Jeremy Grantham's asset allocation team. Kai, welcome to the podcast.
Thanks so much for having me on.
I'm so glad you're here. It's great to have a friend on. And, our listeners, some of them are investment geeks and others are just trying to get their feet under the ground when it comes to money. That's why I said, we may be defining some of these concepts, but I'm going to refer everyone who's listening to a research paper that you published for Sparkline, which is called Surviving the AI CapEx Boom. First of all, thank you for doing this great research and joining us on the podcast. Can you give us a little bit of background of why you think AI is important and why, and then we can talk about, first of all, what is CapEx, and how to survive the CapEx boom?
Yeah, of course. So look, I've actually been working firsthand with AI for 5-6 years now. So starting in 2019, 2020, I got really interested in the idea of, do these models, which at the time they were just called large language models, do they have the capacity to take what's called unstructured data, right? That was in my bio. This is like text and audio and video, and to process it in a way that now the computer can understand what's going on. Right? And these models have obviously evolved into ChatGPT and what's now called AI. So why is AI important? Well, look, this is a technology that allows us to bridge the kind of traditional statistical machine learning tools that are primarily associated with Excel spreadsheets and structured data. Right? Oh, can we do some time series analysis and predict the next line of this trend? What AI or large language models, to be more precise, allow us to do is to now make sense of the world of unstructured data, which involves writing novels or video games or movies, like Hollywood movies. So all this sort of information that is so core to the human experience is now inbounds for these models. And that is, of course, obviously a game changer for how we live in society, how we do our jobs, how the economy works, and really everything in between.
Can you, since I know that you are a user of AI, can you talk about a use case when it comes to investing where AI is changing even your investment process?
Yeah, so I started off as a traditional quant analyst. You mentioned GMO, and they started doing this work in the 1970s, so decades ago, and it was at the time extremely cutting edge, using computers to take financial information from 10Ks and 10Qs, which are the annual statements and quarterly statements of companies, and then automating the process of finding cheap stocks. What I was really interested in doing is saying, can we go beyond just that traditional, again, I'm going to use the term structured data, to instead incorporate these other data sources. So for example, like we talked about trademarks or patents, employee job postings, right? All this information is, obviously very relevant for companies. I'd love to learn for company X who they employ and what sorts of skills they have. I'd love to learn for company Y what kind of culture they have based on their Glassdoor reviews, the text of those things. I'd love to learn about company Z and what sorts of IP, intellectual property, they have based on their patent corpus. That's great. The problem is that to actually manually go through for example, 5 million patents, that would be a very arduous task and probably just not tractable for an individual analyst, and definitely not for a quant using traditional tools. So where large language models come into play is as a way to kind of solve this problem. Or now I have these 5 million patents. What I can actually do is, and now this is going to be a kind of this is going to be a loose description. Effectively,
Just an example. Yeah.
You're having ChatGPT loop through each one, giving a very specific instruction set. Hey, I want you to look for patents related to, say, self-driving cars or robotics. And it can go through there as if you're giving a junior analyst a task, go through this patent and tell me, is this about AI or not, or about robotics or not? And then do that 5 million more times, right? And so it's a way to kind of automate and scale what is a generally pretty basic task, like something you could give to an analyst or an intern, but do so in a rapid, really quickly, over a large scale. And as a quant, now we're able to take these unstructured data sets, these patents and things, and create factors around, hey, is this company cheap relative not just to its trailing earnings, which would be a traditional metric, but cheap relative to the strength of its IP library, right? That's something that you couldn't do before large language models or their predecessors.
So I just think about how much we're swimming in data. Like there's new information every minute of the day. We're kind of inundated with information more than our parents' generation, and like many, many times more than before that. And this is a way to kind of filter and sort through all of that junk when you really can't filter through it to provide a better use for it, maybe.
Yeah, no, I think that's a good description. Look, it's like a two-way street. There's two ways that AI can, do things. One is like as a filtering tool to take this, ocean of information, all the noise, and you go in like social media and there's like all these different posts. Can I like filter through that to extract the signal of things that are relevant to me and my investments? And then the reverse, which is the generative use case, which is, hey, I have a kernel of an idea for like a new movie script. But I'm not really a professional in this space. Why don't I just like give it to, one of these AI models and have it kind of create this whole, script based on, my description, and then I can iterate with it. Right. So there's both kind of expansion and then compression of information available via these models.
So in essence, it's like a bigger toolkit. But then with that toolkit has come serious dollars being invested by some of the biggest companies that we're familiar with. And that is really what your research report talks about, which, like I mentioned, can be found in the show notes. Or if you go to Sparkline Capital, I believe you have every few months new research reports on hot topics. Like I know the beginning of the year in the spring last year, you had a tariff topic. So the title of your article published October 22nd last year was Surviving the AI CapEx Boom. And I think like as soon as you published that, everybody else was like, oh my gosh, AI investment is really getting expensive, at least in terms of investment conversations. But can you tell me like what some of the what is the thesis of the conversation? What problem are you trying to uncover or expose?
Yeah, I think like if I could only say one thing, it would be that just because something's a good technology and it will be transformative doesn't mean it's a good investment. You can go back to the dot-com boom. If you had bought a basket of the most exciting internet stocks in 2000, you would have been underwater for 20 years, despite the success of the internet, right? So let's go back to the current situation. Look, I do believe, and I think you kind of heard some of the use cases, that AI will be transformative for the economy. Let's take that as a given. Now, does that necessarily mean that value will accrue to the folks actually building out the infrastructure? Maybe yes, maybe no. History would suggest no. So let me first define CapEx. I think that was a question from earlier.
Yes, please.
So in order to run these AI models, what's really quite interesting is it's not just a software problem. There's a huge hardware component. There are these things called GPUs, which are kind of special chips that are designed specifically for running these parallel computations, effectively linear algebra, and they're essential for running these models. And what's happened is that these models are so much more compute intensive than the linear regressions and other traditional things I mentioned earlier. It's starting to create a bottleneck where if you're a company or an individual who wants to, if you're OpenAI, let's say, and you want to serve, hundreds of millions of people, these AI models, you need to have a huge amount of servers in order to do that. And what's happening is that, not
And
just
each of those
OpenAI.
servers has the chips in them. Is that correct?
Yeah, so for the average AI data center, it's about 60% of the value is these chips. So it's more than half the value of these things. Generally, NVIDIA, which I'm sure you've heard of, that's the company that makes these chips. There are a few others, but NVIDIA has like the dominant market share. And then the other 40% of the value is like the actual physical, server racks, the cooling systems, the energy, the actual real estate, and and there's a memory component and networking equipment, right? So you may have heard of some of these Taiwanese companies, like, or Korean companies that make memory and storage that have all done really well, these stocks as well. And that's because they're kind of, part of the overall package of that's required to build out these data centers. But the point is that if you look, if you look at how much money is being spent on this infrastructure built out, right? Because we need this platform in order to now run these all the anticipated demand in terms of AI usage.
Mm-hmm.
The numbers are kind of staggering. So just the big four hyperscalers, so that's Google, Amazon, Meta, and Microsoft, are anticipated to spend like what is it, $400 billion a year for the next several years in doing this. If you look at like the broader estimates that include not just the big tech companies, but more generally, folks are estimating $5 trillion of capital expenditures or CapEx being spent over the next 5 years. So $1 trillion a year overall in building out the data centers required to run AI. I mean, this is a massive amount of money. In the paper, I compare it to past similar buildouts. So you can look at the .com buildout. You can look at the railroads in the 1860s when we connected, the entire country of the U.S. Via rail. And as a percentage of GDP, if you adjust for the depreciation and useful life of these assets, it's basically unprecedented levels. So we're, as a society, largely led by Sam Altman and the big tech folks, and we don't, as ordinary people, always have a say in what's happening, but collectively we have decided, we being the country, that we are going to be investing, an inordinate amount of money on building out this next, what is believed to be the next platform for the kind of AI revolution.
Interesting. I want to break that down. First, let's start with the examples that you use. Railroads, I'm going to use my knowledge based on Gilded Age to say that, we had this new technology which can move people around the country and, more importantly, economic goods. It helped to foster the expansion of the country. But also somebody had to go and build the actual, lines that the rail system was built upon. What were the outcomes for those companies that really kind of cornered the market? Seemed like, the richest guy in the room. What happened after that?
So, like in any technological boom, right? So this had happened first in the UK and then later in the US. People saw the potential for this, game changing technology to, create vast amounts of wealth, and as a result, a lot of people tried to do this. So it wasn't really like one guy cornered the market. There are hundreds of railroads that were created specifically to build these out, and so a very fragmented market structure. But what happened is that the adoption of rail ended up taking longer than these guys expected, right? So it took decades actually for the usage of the rail to really ramp up to a point at which these were profitable. And in the interim, basically all these companies went bankrupt. There are these different panics of 2 or 3 different waves when there are these big bankruptcies and consolidations and so on and so forth. But in round numbers, the investors in the builders of the physical infrastructure underlying the rail all went bust. And instead, what's really interesting is I have this chart
Mhm.
here that shows that the actual contribution of the rail to US GDP was actually quite massive. But the thing is that value did not accrue to the builders of the infrastructure. Instead, it went to their customers and the society. So if you were like like a retailer trying to ship goods across the country, well, this is a way more efficient way to do that. And you can kind of build a business around this technology if you're kind of open-minded. Those are the folks who did really well on the back of the rail, not ironically, somewhat, the guys who actually went out there to build the infrastructure.
And I'm aging myself in this part of the conversation, but I actually started my career in the first internet boom. I got my first financial services job in summer of 98. And at the time, we had this huge use case for the internet. There was everything.com. That was, just what everybody wanted to invest in. And in particular, the telecoms, who had been a huge part of our economy for the 20th century, were building a huge amount of ways to move information on the information highway. Is that appropriate to say? So tell me about what happened, between the late 90s and into the 2000s.
Yeah, we basically saw a repeat of what happened a century earlier with the rails. So going into the 90s, there's a lot of excitement around the internet, and folks said, hey, why don't we start investing a ton of money to build out the physical fiber optic cables required to move the information? And thus led to the telecom boom. And these firms, I want to say it was like 80 million miles, but it was a very large number of cables that were laid. It was both kind of the more established players like AT&T, as well as startups like Global Crossing and such,
Hmm.
who were founded specifically to go after this opportunity. Well, what happened is what historians call the capital cycle, which is that this idea that like the economy in general, it tends to operate in cycles with booms and busts. That there's a kind of initial phase where folks get really excited about the opportunity. Capital pours into this market, in this case, the build out of telecoms. And then what happens is there's an overshoot where too much capital comes in, demand does indeed increase, but doesn't increase quite as quickly as is forecast. And there's a point at which people realize, oh, wait, there's now a glut of supply. There's too much build out, not enough usage. In the case of the .com boom, I think 85% of fiber optic cables were not used in the bust. So in 2002, let's call it, after things went south, 85% of cable was dark. And what that meant, of course, just based on Econ 101, is that the prices collapsed, and so bandwidth was basically 90%, at a 90% discount from where it was earlier, which was obviously very bad if you're a telecom company who's like lively relies on being able to charge your toll. You're effectively a utility, right? And so many of these companies went bust. Those who didn't suffered. So there's an index called the NASDAQ Telecom Index. That thing went down over 95% in the .com bust and still hasn't recovered even today, which is kind of wild. So yeah, maybe you wouldn't have gone bankrupt had you bought a basket of these guys, but it wasn't a great opportunity. Now, and then the postscript is kind of what I mentioned with the railroads, which is the flip side of being an infrastructure builder is being what I call an early adopter or a user, or someone who's actually not outlaying the capital to build, but the one who's actually trying to take advantage of the new technology in order to drive gains. So let's say you're trying to
Increase productivity in your existing business.
exactly like what I just discussed. I could go out and hire a bunch of analysts to read patents, but I'm just going to use my AIs to do that instead. That's a productivity enhancing use of this technology, and there were many of them as well during the .com boom. And so those companies actually did really well. And like the best examples were Netflix and Google and Meta, right? Where they basically their businesses are premised on the idea of streaming content, back and forth over the internet. And to the extent that's expensive, it makes it really hard to make that business work. But with bandwidth prices 90% discounted, actually it was a great time for those guys to launch. So look, like everything's a flip side. There's almost a subsidy in effect here. The overbuild at what I call the infrastructure layer, so too much fiber, led to a subsidy for the users of technology. So it's kind of like there's like two sides to each coin. And again, like when you think about investing in any technology or any market, you got to think that maybe it's not a monolithic asset class. Like there's no such thing as an AI stock. People are like, oh yeah, I want to buy AI stocks. What does that even mean? Right? There's like different parts of the value chain. And I think the easiest way, because obviously you could segment the value chain a million ways. I think the easiest way to do so in the simplest, fewest buckets is to say there's two halves. There's the infrastructure builders, NVIDIA, supplying the chips, Microsoft putting together the data centers, CoreWeave, firms like that. And then the model companies like OpenAI and Google, who are actually investing, billions of dollars to train the models. And then there are the users or the early adopters of the technology that then take that model and use it to make their businesses work more efficiently and hopefully drive profits from that. And so I think where the hype is, where the excess has been both on the capital side and on the valuation side is really mostly focused on the first part and very little on the second part.
Well, and I think that makes sense because when you just look for pure plays, it's attracted so much assets, especially since I guess the fourth quarter of 2022 when OpenAI kind of launched. And so I want to talk a little bit more about, well, first, just like, and that is a fact, like it's been a huge driver of performance when it comes to S&P 500 returns until very recently, correct?
Yes. I
And
think I
then
think 85% of the returns of the S&P 500 have been driven since ChatGPT's release have been driven by these infrastructure stocks, and more particularly even just like the Mag 7 and a few other AI linked stocks.
And, that's where discussions about concentration of the biggest companies being a bigger and bigger portion of indexes has come in, and just the economy in general.
Yeah,
But then you go further in your paper to also kind of explain this, that what you really want to be looking at when if your thesis is correct for investments going forward is that change in terms of capital expenditure. And you spend some time researching and explaining to us what heavy or intensive CapEx companies, um, how their investment results are different from lighter capital expenditure companies. Can you talk a little bit about what you found there?
yeah. So basically, capital intensity is a question of how much capital does a company need to like run its business. On one extreme are utilities, which are extremely capital intensive. You're always kind of putting more money in to replace depreciating assets that are either becoming obsolete due to technological change or just through wear and tear or like wearing down. It's a really hard business to be in, and there are very limited moats, right? Like the only moat you have is the ability to kind of spend more money, which is not truly a moat. In contrast, there are what are called asset light businesses or non-capital intensive businesses, I guess, which are kind of the opposite. The best example would be like Google, say 10 years ago when they had, when they were focused on like say search. At that point, like they had raised very little relative money in terms of getting to IPO. And so they basically didn't need to raise that much money to run this business where they just printed money, right? Their return on invested capital but was insane on that business where they
Very
don't really
high
require
margin, so they make a lot of
extremely high.
profit off of a lower amount of investment.
Right. They don't have to keep spending money to just run this machine that keeps cranking out profits. Right. So that's an example of an asset like business, right? They use network effects. They have, strong intellectual property, a good brand, a lot of human capital. They built like this culture that for, I think it was 7 or 8 years straight, they were the Glassdoor's best place to work. Right. So you think of Google in their heyday, that was kind of like the perfect business, like super asset light, like, they were just, pure profit.
And that
But
really,
that,
I mean, I like this is getting a little bit off topic, but didn't that allow them to go into many more businesses because with that profit they invested into more ways to make money that were because they didn't have to just put it back into the ground to build up another power plant like a utility would.
Yeah, that's right. I mean, we saw today that Waymo, which is a self-driving car company that they incubated, just raised some outside money at like a very significant valuation. And why does Waymo exist? Because Google was able to, through the cash flows generated by their main business, fund some side projects, some of which
Mhm.
didn't work out, but many of which did, such as Waymo. So it puts you in a great place to be asset light. Now the problem is that Google, to take Google as an example, they are becoming more and more asset heavy over time. So if you look at like the capital intensity of these businesses, so the main metric would be how much do you spend on CapEx per year divided by your revenue. So what percentage of your revenue do you need to spend on capital expenditures each year? Historically, these companies ran about 4%, so basically nothing. And now they're at 15. These are the Mag 7, so the largest 7 tech companies, including Google and Microsoft. The extreme is Meta. So Meta is spending 35% of their sales on building out AI data centers, which is a crazy amount of money. For context, AT&T at the height of the dot-com boom, they were at, I want to say 18%. So or maybe even less, so in the teens. right? So these
And
guys
another
are,
traditionally asset light company where, they have a website that's running, that's getting data that they can use to sell ads to people to kind of, get into our living rooms, our hands. So a huge shift in terms of what got them here versus what they think will get them to the next phase.
that's right. Yeah, Meta, Facebook, they're another perfect example of an asset light business, right? Like a social network that was purely software driven, that had massive network effects, and had really high profit margins and didn't require too much capital to run. So these are all examples of businesses that were kind of the perfect business, but are now transitioning, because what's happening is that this AI opportunity is creating this like kind of competitive dynamic whereby these firms all view AI as an existential threat. They're all like, okay, we used to kind of divide the kingdom up, right? It used to be an oligopoly where like Meta had search, and then Google had search, Meta had social, so on and so forth. But now what they're saying is, wait a second, whoever wins AI wins everything. And therefore,
And we're going
in
to be
order to
disrupted.
survive,
We're going to be the blockbusters if we don't
right,
do whatever it takes to win this war.
right. So you have guys like, the CEO of Google or Meta saying, look, I'd rather go bankrupt than lose this race. It's almost like
That's
an
an
ego
actual
thing
quote,
too.
right?
Yeah, that's it. I mean, I think that was that Larry Page who said that, right? So
Yeah.
like these people are actually saying, we're going to go after this no matter what, right? Meta, they actually had a pretty decent quarter when they announced, was it last week? But people are definitely looking at that CapEx number, being like, it's a little bit scary, right? Like let's hope he doesn't do the same thing he did with the metaverse. Um,
Well, and that's changing, the equation because a lot of it is early stage funded out of cash flow, but and this can be an entire different episode topic. We're not going to solve all the problems of this here, but borrowing is happening. Some of the borrowing is at a higher number so that it stays off balance sheet and private debt deals. There's all sorts of implications that are complicated. And I'm getting us off track, but like, what did you find about these capital intensive companies relative to their peers that are more capital light?
Yeah, so one of the nice things about being a quant is that I have, decades of data and over thousands of stocks. And I can look at not just the big, macro booms and busts that we discussed already, but even like kind of more micro cases. Like for example, how would a materials company that was investing heavily in CapEx in a given random year have done relative to its peers who are investing less heavily? And it turns out that both
And
on
even
that
in
kind of set
utilities, there might be more or less capital intensive
dispersion.
companies, even if they invested more than the index in general,
That's
right?
right. Yeah, and I found that, whether we're talking about, just in absolute who's spending the most or sector neutral. So within financials, within technology, within utilities, who's spending the most, there's a pretty consistent pattern where those firms that invest heavily in capital expenditures tend to subsequently underperform their peers. And that's not to say that there's no like, counter examples of firms who, manage to pull it off, but just if you're if you're a betting person, right, you're just playing the odds. You say,
Hmm.
well, the base rate here is not exactly in your favor. And that's both for firms that are investing heavily in aggressive balance sheet growth, aggressive capital growth, and for those who are just more capital intensive in general. Like, just have a higher capex to sales ratio. In other words, they're not necessarily investing for growth; they're just investing to tread water to maintain. They're just worse businesses. And the concern, of course, is that the biggest companies, the Magnificent Seven, which I mentioned, as well as many other companies, are becoming more capital intensive as a result of AI. So AI boom's happening, whether we like it or not. It's now causing many firms, including and most notably big tech, to really push into this. And here's the problem, which is if it were just one small segment of the market doing this, fine, right? But the problem is that these companies are most of the index. So the S&P 500 index, 1/3 of the index is the Mag 7 stocks. And then if you include also like other infrastructure companies like, Broadcom, you get to a number that is around 50% of the index. So if you're a normal person, you put your money in the S&P, you're like, oh, whatever, it's a passive index. Like I'm just going to diversify by the market. Well, you're not really diversified because half your money is in basically a massive bet on this infrastructure build out being successful. And the success of the build out, again, is not about the technology being successful. That's obviously one requirement, but it's not sufficient. What you also need is for the thing to be successful and for end user demand to pick up fast enough before the depreciation of these assets. So this build out is happening. We're spending all this money up front and building out these data centers. If the demand materializes quickly, then we're good. But if it's like the internet or the railroads, where it takes maybe a little bit longer than they might have thought, maybe it still happens. It just happens in, say, 5 years, not 3 years. Well, then there's this huge gap in profitability, and that could mean potentially this overcapacity issue. The capital cycle turns, and maybe we'll end up in a situation like we did historically, where it's not so good for the builders of the infrastructure, which represent half the index, as I point out.
Well, I could talk about this all day, but I want to talk about some of the investment implications. I have some thoughts, and I know you do as well. Let's just start with the way you've chosen for kind of your core investment strategies that you offer for investors, how you've approached, kind of building a portfolio and what you're focusing on.
Yeah. So the key insight that we have at Sparkline is that value is not just the tangible book value of a company, right? So if you go back to like the history of investing, like Warren Buffett, Ben Graham, all this stuff, there's this idea that book value is kind of the proxy for fundamental value. But what's happened is that over the past century, basically, the economy has transformed massively, and we've become very asset light. The best businesses are like the ones I just described, and so it's intangible assets, which I define as intellectual property, human capital, brand equity, and then network effects. Those are kind of the four pillars that are actually driving value today. That drives, let's say, half of the value of companies in the market in general. And then in the most profitable subsegments of the market, like technology and the large caps, 80% or more, right? So most of the value of companies is no longer tangible, but intangible. And I think that creates a huge opportunity because most traditional investors, especially quants, are still very fixated on kind of these old school metrics. And for them, they're never going to buy a company like NVIDIA or whatever, because they're always going to seem expensive if you don't give them credit for their intangible assets, right? And conversely, your so-called growth investors are going to always own these things because they think that there's always opportunity, but they have no idea when to sell out. They have no sell discipline, which means that when the bubble comes, and maybe we are in one, it's going to be a little bit hard for them to sidestep the potential losses from compression of multiples and such. So we're kind of trying to basically take this old school idea of value investing, buying stocks that are cheap relative to intrinsic value, but then adapting the intrinsic value to concept to include a more holistic definition of intangible plus tangible assets that allows us to take the framework into technology stocks and things like that most traditional value investors tend to eschew.
And this is a full circle episode moment, because in the beginning you talked about some of the ways that you're doing that type of research, which is you're using some of the tools that wouldn't have been available before the large language models and big data sets existed, and applying your quantitative trading skills or investment skills, research skills, to that. So I appreciate kind of that coming full circle. Another, kind of thing, just as a wealth manager, I think about is, with the Magnificent Seven, which is necessarily, intertwined with this conversation about a pivot to higher, more capital intensive activities. There are millionaires, decamillionaires, centimillionaires who can attribute much, if not almost all of their, kind of success and net worth to being, kind of riding those horses of the Magnificent Seven into the sunset of so far, where, there's been huge wealth building from the returns of these companies. And it's so difficult when the recent history to think about diversifying away from them. But this is, kind of a cautionary note of taking careful consideration for how you diversify. There's much less AI exposure around the world than there is in the US. If you look at markets, like the way, you can articulate investments, and there's a lot of cautionary tales. I'll use the tech wreck of the early 2000s and the internet boom. The first internet boom is an example where, kind of what got you here doesn't always keep you safe going forward. So I think that there's definitely some considerations for those of you who have, significant exposure to single company or the cohort of the Mag 7. I don't know if you have any thoughts on that.
Yeah, look, what I would add is yes, I agree with that. I mean, our funds when we launched initially were actually overweight a lot of these infrastructure stocks. So we're not like a traditional old school value investor. We actually said, look, Nvidia at 100 PE ratio is actually cheap because of the prodigious value of its IP and its network effects and human capital and such, right? So we were very much on that trade. But what's happened is that over time we started to just naturally rotate out based on the valuation framework I outlined earlier, as we started to see these companies appreciate in value what we believe to be too much relative to the prospects. And what I would add to your point is, look, I completely understand what you're saying, which is it's very psychologically difficult for someone to cut your winners, right? That seems like the wrong thing to do. But on the other hand, I mean, these kind of blessings, right? Like, as a index investor in the US or as any investor in the US, we've likely benefited from, probably above expected gains, right? Much more than historically would be expected over the past decade due to the rise of AI and technology in general. Maybe take some chips off the table. What I would say is this to your other point, which is, one of the challenges with navigating the current environment is it's oftentimes framed as this kind of like dilemma, a dichotomy. Either we invest in AI, so US large cap stocks, and we get AI exposure, but with kind of concentration around infrastructure capital risks and around high valuations, or we go abroad, we go to value stocks, we go to small caps, we do equal weighted S&P, and these things give you diversification away from the Mag 7, but we lose AI. We are now invested in a bunch of kind of old economy companies, laggards in the AI race, to use the technical term, who are likely going to be disrupted as the technology pushes through. What I would argue is that there's a third option, which is what I call like the AI early adopters. I alluded to them earlier. These are folks like I mentioned, some around the dot-com boom and some around the railroads, folks that like in the kind of, they are not, they're not the picks and shovels. They don't sell the infrastructure. They're not Nvidia. But, in those companies only are about 10% of companies. The other 90% of companies are what you would consider users. And within that, there's a huge amount of dispersion. There's some companies that are really aggressively investing in AI. They're really trying to capture the opportunity they see around the corner. They know this is going to be a big thing, and they're doing everything they can to position to benefit. And then there's, some guys in the middle, and then the rest of the folks who are kind of just head in the sand, they don't even care. They just want to kind of milk their current position and hope it just goes away, right? And so what I would say is that there's this middle category, the early adopters, or actually I think the best positioned, because they stand to benefit from these technology, and for them it's only a relative game. Can they do a better job using AI than their competitors, who, as I mentioned, many of whom are just not even looking at this at all?
And so, like, a couple anecdotal examples, either add in or elaborate. I know I often see Caterpillar mentioned there.
Yeah.
Walmart. What are some, like, these are not like brand new companies. They're just using the new technologies to adapt, right?
That's right. And you see these examples across industries. So it's industrial, as you mentioned, JP Morgan, banking, like you see this kind of all over the place in healthcare, pharmaceutical, drug development. There are all these little use cases for AI, whether it's something as basic as like making call centers more efficient, to like in the case of Walmart, like logistical and kind of warehouse inventory management of like a long amount of SKUs. Like you see there's a lot of different interesting use cases. Actually, the paper that I'm writing up now has
that was going to be one of my questions. Okay,
through them, yeah, where we just kind of scan public company earnings calls. So this is all public information, and look at what it is that companies are saying. What percentage are reporting AI usage? What percentage of those are reporting positive ROI from their usage? So not just, hey, we're trying this new pilot, but actually, like, oh yeah, we actually managed to cut costs by 20%, or increase our ad conversion rate by 5%. So these things are popping up all over the place now, and at a kind of accelerating rate. So from a low base, admittedly, it's not like a ton. I think it's like 15% of companies that are reporting some positive benefits, economic benefits from AI, but that number is increasing pretty rapidly. And you look at how the technology is evolving, just being someone who's kind of in the weeds, on all the Twitter and Reddit forums or whatever, and kind of seeing how fast this stuff is moving. And you can kind of easily extrapolate out that S curve and how it goes. But the point is that these companies, just in all industries, it's not just technology. It's not just, the kind of common spaces. It's not just Palantir. That these companies, they may be in kind of sleepy industries, but that's almost good, because one, it means the competition is a little weaker, and two, their advantage has never been their technological prowess. Their advantage is their installed base, the fact that they have, all these customers and all this proprietary data they've been collecting over the years about these customers, and have the ability to kind of then leverage any technology, over this larger installed base. Talking about a 2% improvement on a huge amount of assets where profit margin is 5%, right? Like that's a huge addition to their economic value. And I think these companies are really interesting because if you look at the valuations of them, relative to what I call the laggards. So what I did was I said, let's look at all the companies that are not infrastructure, and we'll divide it just for simplicity into like the adopters, early adopters, and then to the laggards. These two different groups. Well, it turns out that the valuations of these two groups are basically the same: price to earnings, price to book, price to sales. And what that means is that the market's not distinguishing between companies that make AI investments versus not, which is kind of the opposite of what's in infrastructure. In infrastructure, companies that make investments, when Oracle announces that they're doing a deal with OpenAI, their stock goes up, right? That doesn't happen in this other space. But investors are kind of, I think, sleeping on the opportunity in the Caterpillars of the world, companies that are actually positioned well for AI and have other advantages that they can kind of synergize, I guess, with AI, yet aren't trading at the kind of crazy valuations that we see in the infrastructure space.
Well, that's interesting. It may foretell part of the reason why there continues to be such strong and positive forward earnings expectations from some of the best companies out there, which aggregate into the S&P. And I think that like leads into my third kind of investment lesson, which is that everything's not binary, everything's not black and white. It would be unrealistic, and I would likely ill-advised to scrub your exposure, for example, to the 7 largest companies in the S&P 500. But thinking about, kind of diversifying, hedging your bets, avoiding concentrated stock issues, as well as recognizing that no one has a crystal ball. Things will continue to evolve. While Kai, you may have had special insight into kind of the AI story unfolding. It wasn't, something that everybody knew, but, around the corner is some other unexpected, curveball, but also innovation and opportunity. And so paying attention to your investment discipline so that you're, kind of facing forward and not resting on your laurels, I think just like those companies that are innovating and finding their productivity by staying with the times, is important for your investment portfolio.
Exactly. Right. Exactly. I think, if your goal is to, kind of maintain your wealth, you need to be diversified. And again, it cuts both ways, but, for most investors, and, I'm generalizing, obviously, is we've kind of written our winners, and our winners have been US large cap stocks, in particular, the largest ones. And the trades become so concentrated, so crowded in a single theme, which is, will this AI boom, capital boom continue? That like it in a way is kind of crowding out all the other ways of diversifying. And so I would say generally, do think a little bit about kind of thematically what else there is out there, whether it's the value stocks, the small caps, the international stocks, different ways to get exposure, that isn't just all levered to a single trade.
Well, I think I've alluded to it, Kai, but where can people find more, read your papers, and read the other papers that you've written?
Yeah, so you can just go to my website, sparklinecapital.com. That's SPARKLIN capital.com. And so, I did my last piece on AI CapEx. I did one on Warren Buffett, because he's retiring, obviously, and kind of thinking about the evolution of his own journey as an investor from being kind of more old school, buying, textile mills, all the way up to kind of buying Coca-Cola and then Apple, of course. So the extent to which his investment process also mirrors kind of the journey that I've been on, trying to add intangible moats to the framework, and then the trade wars. And I did one on kind of partisan investing. The upshot is don't invest based on partisan politics.
Don't, don't invest on who's in charge. Yep.
Yeah, it turns out that that's not a good idea. But there are other ways you can actually take advantage of trading around elections, namely around, well, this is going to sound bad, but like regulatory capture. So companies that do a lot of lobbying and do a lot of, political donations, they actually do better, right? So they're building an intangible asset. That's their political influence, and you hate to see it, but that asset has value. And in fact, like the crazy stat I found is that the ROI, so the return on investment in $1 of lobbying, is like an order of magnitude higher, so 10 times higher than a dollar of investment in like a R&D, right? So you hate
Wow.
to see it, but it is what it
But
is.
you'd rather know than just have that information floating and without your ability to use it, I guess.
Yeah, I mean, as an investor, these things all matter, right? We're just trying to find, edges and trying to understand the value of companies. And some companies, that's kind of the main point of the company is that they have, a special regulatory monopoly, and it is what it is. That's just, you can't, what are you going to deny the fact? If it's a fact, it's a fact.
Well, thank you for bringing these important and just thought-provoking topics to the table, Kai. I appreciate you joining us today.
Thanks so much for having me on.
Thank you for listening to the Women's Money Wisdom podcast. If you found value in this episode, the best way that you can support the podcast is to forward an episode to a friend or leave a review. Go to proplan.com and the podcast link to get all the resources and links mentioned. This presentation by Pearl Planning is intended for general information purposes only. No portion of this presentation serves as the receipt of or a substitute for personal investment advice from Pearl Planning or any other investment professional of your choosing. Copies of Pearl Planning's current written disclosure brochure and Form CRS discussing our advisory services and fees are available upon request or on our website platform at pearlplan.com. The information that we share is meant to educate and inspire, not serve as personalized financial advice. Everyone's situation is unique, so be sure to consult with your own financial professional for guidance that fits your life. And just so you know, the opinions shared in this podcast are Melissa's own and those of her guests. They don't necessarily represent any organizations with which Melissa is affiliated. For more important disclosures, please go to our webpage at pearlplan.com.